Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. Welcome back to the Commercial Property Podcast. And today, I'm talking about why it's so important to strategically invest in property. And I'm going to specifically refer to commercial, but I think this is true for any type of investments that you make. I think, first of all, we have a portfolio to build, and what percentage are we going to give to each asset class? And so I'm going to be talking about commercial property today. But actually, this is relevant for anything that you're doing, although obviously I'm going to specifically talk about some of the pros and cons from a commercial property perspective. So let's get going. So one of the very first things I say to my board members, my board is my 6-month program that I work with clients on. And we meet up in person once a month, and I follow I call it a racetrack, but it's basically an agenda for the 6 months. And there's a reason why the first month is all about starting with the end in mind. It's about where do you want to get to, and then working back from there. And really that is the first thing about investing strategically, because I think that there's a lot of press from property trainers and a lot of noise around property investing. And sometimes it's right for people. Very often it's absolutely right. I mean, obviously it can create hands-off income. It can create freedom from kind of time for money type work. But also for some people, it may not be for them, or may not be for them right now. It might be that there's certain types of investing that would suit them better than others. So for example, if you have a full-time job and you're very, very time poor, then, to invest 250 miles away from home, possibly, unless you've got a link there, isn't particularly realistic. But, that's when you might want to start investing closer to home. There might be certain types of asset class that might suit you in terms of your previous knowledge, or it might be that you have a certain amount of money and you don't want to bring any other investment in or whatever else. And so therefore it might be that actually you want to stick to a deal or deals which suit the amount of investment that you have available. So there's always a reason why you're doing what you're doing. But where I start with board members, and obviously this is a very, very detailed process we go through, is first of all kind of the why. Why do you want to invest? Because I think the easy answer to that is that we want to invest to get more money. But money very often, in fact, I would say 100% of the time, isn't the reason. It's what money can buy you. So whether that's time, whether that's experiences, whether that's contribution, there's so many reasons. And I love working with board members on this because, I do this exercise myself and I review it regularly for myself. But when I work with board members on this, all kinds of reasons come forward, to spend more time with ailing parents, to set up a charity, to travel more with children, whatever else it might be. And actually, funnily enough, it's very often not, I want to buy a Ferrari or I want to buy a massive house. Sometimes it is. And of course, there's no right or wrong in terms of what you want to achieve, but it's about kind of understanding that. And I think, rather than being swept along thinking this is what I want to do, it's about understanding where you want to get to. And that's important for several reasons. Number one, it's your driving force. It's your North Star. It's where you want to be. Number two, it might be that actually there's a limited amount of money that you need. And you might, when you actually do this exercise, and I've done this numerous times with many, many clients, and I've done one recently where, we went through actually the short-term cash flow requirements from property, and it was probably about a tenth of what the client actually thought it needed to be. And we can do that in one deal. Genuinely, we can do it in one deal with the amount of money that she's got available. So it's about kind of not overcomplicating this. It's about not allowing those myths to get in your head and actually looking at the reality of the situation. And it's also about understanding when to stop, because, you know, is there an end point? Do you find deals fun? Do you want to carry on? Or actually, is there a point at which the hassle and the risk isn't going to be worth it? And therefore, you know when to stop. Now, obviously, you never stop when you own a portfolio, because you're constantly reviewing the portfolio, asset managing it, make sure that, it stays profitable. But in terms of actually going out there and finding deals and striving to find deals, that there might be an end point to that. So it's really important to understand kind of all these whys and kind of North Stars, endpoints, so that you can kind of invest really strategically. And of course, understanding what money you've got available as well. And I've just done a webinar with Wealth Builders, who I work very closely with, Kevin Whelan from Wealth Builders. And we were talking about how to invest with pensions, like SASs, self-administered pension schemes, and SIPs, and also, different company structures as well. And I'm going to just touch on that today because it's so important. And it's very easy to buy property, actually. I mean, anyone can go out and find a property, but finding a property that's going to be profitable for you, where you can add some value, that is going to tick your aims and objectives, and investing in a structure or in a way that actually is going to mean that you keep money as much as making money is really, really important. So let's just kind of touch on that, keeping money rather than making money. So obviously both are super important. You have to find the right deal. You have to buy it at the right price. And I've talked about this many times on this podcast and, to clients who I work with. But actually, investing in the right structures can save you money as well. And if you think about it, this is what all investors do. Whether you're the most super wealthy investors or the smallest investors, you need to work out a way of investing in which is going to be most tax efficient. It's going to be the most liquid for you. It's going to suit your aims and objectives. So, for example, if you are over pensionable age and you want to build up your pension, then obviously there's a route in terms of a SAS or a SIP that you want to go down, and you may not want or need to draw from your pension because that might limit the amount you put in. So there's a strategy around that you need to work up. And Wealth Builders are really, really good about kind of SaaS strategies. But I work with a lot of SaaS and SIP investors for obvious reasons, because you can invest in commercial property inside a SaaS or a SIP. So we're going to talk a little bit about structures, and then we're going to go back to talk a little bit about niching and why that's important. And those of you who've kind of seen me talk and listened to this podcast before will know that I rate niching very, very highly for commercial property. It's super important. It's one of the most important things that you can do in your investing. So we'll loop back on that at the end. But first of all, let's talk about structures. So we've looked at the why. Why do you want to invest? Where's your end point? And if you haven't done that exercise, I would strongly encourage you to grab a piece of paper or a journal and just do some writing around that, just some thinking around it, because, this kind of strategic stuff it's your life. Every day makes up your life. And so really understanding this stuff is so important before you get going. Or even if you've got going already, if you're a resi investor, if you're a business owner, then obviously really important to understand the role that commercial property plays within that overall portfolio and within your overall aims or objectives. But then in terms of company structures, that's really, really important. So one of the first people I get clients to talk to before they invest is a broker, but also an accountant, and not just any old accountant as well, because there's different disciplines you need to work with when you're doing investing to actually make sure that you maximize on your structures and the way that you invest in commercial. So first of all, we've talked about pensions. You can invest within a pension. You can also lend money from your SAS. to your limited company, to a linked company. You can lend up to 50% of the pot. You have to pay back capital and interest over 5 years, and it needs to be really commercial, and it needs to have a first charge. Your pension needs to have a first charge. Or you can invest in a pension, like a SAS or a SIP. The beauty of that is that you can invest in commercial but not residential in a pension, but also you can be tax-free within that wrapper of your pension. So no capital gains tax, no income tax on your income, and obviously that's a huge benefit. But that might not suit some people. It might be that you're not of pensionable age, and you have a short-term cash flow need to bridge a gap, or your aim is to invest outside a pension to begin with, and then kind of strategically invest in a pension. And so a plan starts to form. It might be that you actually then use your SAS to invest outside your pension, build your personal wealth or your company wealth, and then kind of when you're at the age when you might want to start drawing on your pension, or a few years before that, starting to invest in your SAS. So again, there is a strategy around this, and that needs some thinking about, because it's not one size fits all. There will be a different answer for everybody who is listening to this in terms of what suits you if you have a pension of that nature. Of course, if you don't, you may want to actually build a brand new SAS up, and you need to do that from profits and lump sums. So again, thinking about kind of how you do that is really important. And there's different levels to the type of money you might want to get from your investing. And again, I take my board members through this. So the first level is cash flow. So that's basically basic outgoings every month. If you're not got cash flow covered, then building pensions and building profits, lumps of money like development, can be highly stressful, because you're constantly trying to pay the bills from kind of ad hoc income. So I would strongly recommend that you build the cash flow first. Then you can build profit, which is basically lumps of cash coming in, a bit like a bonus, and pension as well around that. But getting cash flow covered is really important. The amount of clients I work with who want to go straight into development, it seems exciting and sexy, but actually, if you haven't got your cash flow covered, then development can be highly stressful, because you need to pay the bills. So you're either it's feast or famine, basically, when you're looking at development. So think about kind of the objectives with regard to kind of what kind of income you're looking for, and obviously investing accordingly. And there's different types of deals that will suit different levels of income within that wealth hierarchy. And this is something that I take all my board members through. And then actually the way that you invest in property can be hugely advantageous, especially if you can start with the end in mind in terms of how you may want to exit. Now, from experience, sometimes it's very difficult. So we've done investments where we've thought that we may want to hold them long term, and then we've made a decision for various reasons, either because of performance of assets or because circumstances have changed or whatever else, that we decide that actually or markets change. Actually, it might be that kind of markets change, and actually there's better opportunities elsewhere, which has meant that we've basically sold a lot earlier than we planned parts of our portfolio. And so sometimes planning ahead can be quite difficult. You plan to hold long term, but actually you may want to sell. So some flexibility around that, and scenario planning is really, really important. So basically, one of the first people I talk to is my accountant. I talk through the different structures that we can invest in. And of course, there's different types of company that you can invest in. There's trading companies, which is basically trading income. And then there's investment companies, which are investment income. So investment in property is usually done directly in an investment company. And it might be that you are splitting titles. If you're splitting titles and you're creating new leaseholds, it might be that you need to create a freehold company and a leasehold company. So a freehold company to own the freehold of properties, and a leasehold company to hold leaseholds. That might be that you're buying mixed-use properties and you're granting long leases over flats to get finance. It might be that you're granting long leases over commercial property. And then some kind of holding company structure is super tax efficient. Now, this is not tax advice. I'm not an accountant, but talk to your accountant about whether a holding company structure might be suitable for you, so that you can basically share gains and losses within a group. And, sometimes that can actually be really beneficial. Obviously, not all the time. It's definitely horses for courses. And then, these holding companies, they can be, sometimes there's offsets of tax if you're holding properties in a trading company. So development, for example, is a trading activity. In the residential world, serviced accommodation is a trading activity. So do you want to hold those in a trading group? And there's various kind of capital gains tax, corporation tax benefits potentially from holding those in a trading group. So it's sometimes I find with accountants about asking the right questions. You don't know what you don't know sometimes unless you've been through these structures. So it's about asking the right questions of your accountants in terms of the right structure. It might be that you want to hold a company in an SPV. And sometimes an SPV can be really helpful, especially if you want to sell. So it might be that you're doing some asset management and then you want to sell and get some, a lump of profit that you can invest in something else. It might be that you're doing a development and you want to sell that. And an SPV means that there's ring fence risk. Obviously, that's one benefit. You can hold an SPV in a holding company and again have the same benefits of that holding group. But again, you must speak to an accountant to make sure that suits your particular circumstances. But if you are selling a company, so if you've only got one property in a company and you sell the company, then the purchaser may only need to pay 0.5% tax, and as in stamp duty, rather than full stamp duty on that property. And so it's a very well-worn path in terms of buying companies and disposing of companies. So obviously, the less stamp duty they have to pay, the more benefit there is in terms of potentially an upside in price, because you are selling the company rather than the property. So again, something else to talk to your accountant about, whether an SPV might be suitable for that. It might even be that you're not going to sell it in anywhere near the short term, but actually longer term, that would be suitable. And you may also want to ring fence risk. It might be that you've got a JV on properties and you hold that again within an SPV, a ring fence SPV. Lots of different ways of kind of structuring these things. Your holding company could be the shareholder. Again, this isn't tax or structuring advice, just some questions that you need to ask the professionals in terms of how to do this stuff. And then the other thing, of course, is VAT. So something that is different about commercial property than residential is that VAT can be chargeable. Not always, but it can be chargeable. And so you may be buying a property that is opted to tax, which means you have to pay VAT on the purchase price. So that doesn't necessarily mean that you have to pay the VAT. If the property is let and it's trading, it might be that it's a TOGC or a trading as a going concern. It might be that you want to hold everything in a VAT opted company, or you hold it in a mixed company where some properties are subject to VAT and others aren't. But again, your accountant can advise. It's just things to think about. And then finally, in terms of capital allowances, so a real benefit of commercial property is capital allowances. And what that is basically claiming a percentage of the plant and machinery in the property and a small percentage of the fabric as well. And, on HMRC's own figures, about 95% of commercial owners don't claim capital allowances. And so if you're buying a property where you think there might be capital allowances, do you have any tax to pay elsewhere? So, for example, if you're selling properties, residential properties in your own name, would it be beneficial for you to buy a commercial property with lots of capital allowances in your own name to offset some of that tax? Or, would it be preferable to buy that in a limited company where you've got other tax liabilities over time? So again, no right answer for that, but it's definitely horses for courses and stuff to talk to your advisors about. So structuring commercial deals, structuring any deal, it's so important to do that. Start with the end in mind. Do it from the outset. Structure it properly, and it'll save you so many headaches. We have done this over time and used our accountants to do this. And, this is not a solicitor's job, by the way, this is accountants. And try and use a property accountant as well, because they understand the whys and wherefores. But even if they're specialists, you need to know the right questions to ask them, because sometimes they're not offered up straight away and you need to kind of tease it out of the advisors. So definitely speak to a broker about finance, but definitely very, very, very early on, speak to your capital allowances surveyor, who's usually a separate entity from your accountant, and speak to your business and tax accountant and a VAT accountant if that's relevant as well. All of those parties together will give you the right advice, hopefully. And if you don't feel you're getting advice, obviously you need to shop around from that perspective. So structuring is really important. And last but by no means least, and actually it's the first thing we need to look at, I promise you I'd come back to niching.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
So niching is really, really important for your commercial investing, because we've started with the end in mind. We understand what we want, and therefore we need to find commercial property that suits those aims and objectives. And there's no point kind of setting aims and objectives and then completely going off left field and kind of chasing the shiny pennies. All of this about is being highly, highly strategic. I've got a corporate background, and I have learned this stuff from corporates. Corporates don't just willy-nilly invest, and you can do that in commercial. There's so many different types of commercial property. If you think about commercial is basically any types of property which is occupied by a business, then obviously there's so many different types of commercial property. So it's really, really important to be highly, highly strategic in what you're investing in. So this is where niching comes in. So you can, obviously if you're limited in terms of time and money, then that might dictate kind of the niche, whether that's close to home, or it might be that you have to invest further away if you haven't got as much money, or you can obviously start working with investors or JV partners. It also is with regard to, where are the trends? Where are the trends at the moment? Where are you going to see capital uplift for the next, decade in different types of property or different types of location? What sectors are definitely tipped to succeed? What locations have got inward investment, more housing going in? And there's small niches that are really highly profitable, but the masses just don't know about them. And that's the beauty of commercial. So one thing I work with my board clients on really closely is the types of deal they're investing in. Start with the end in mind. Find the right types of investment that, mean that you can either be hands off or kind of make the profits or get all your money out on day one, or whatever's important to you. And ultimately, there's obviously lots of different nuts and bolts that are really important in that, like buying at the right price. I would just ignore asking prices at the moment and buy at a price that you can afford. So lots of different tips and tricks you can do that. You need to add value and have multiple exits. So lots of different rules that I work with my clients on. But ultimately, if you can niche your strategies into 1 to 3 niches, you become the expert in that. You can build relationships, you can find the deals quicker, you can save time, and ultimately money as well from kind of abortive deals, etc. So lots and lots of different reasons to niche. So starting with the end in mind in any type of investing is really important. Scattergun investing is definitely not recommended. And so finding out, kind of understanding the reasons why you're investing, thinking very strategically about how many properties you want, what kind of income you want out of those properties, and then finding the types of properties that will absolutely tick those boxes through niching is really important. And then when you actually find deals, obviously structuring the deals from an asset management point of view, so you know how you can get money out. So sometimes you can do that on day one, for example, if you do title splits, or you might have a longer term approach. Structuring finance accordingly, we haven't talked about that today, but you know there's separate episodes on the Commercial Property Podcast about commercial finance. You know, always speak to a broker early on, and then make sure that you structure the transactions appropriately to keep money as much as make money. And you know, if you are planning to trade properties, if you're planning to hold properties, there will be different structures that you will want to hold the property in. Be mindful of property taxes, stamp duty, VAT, capital allowances, and you know, all income tax, corporation tax, etc., all different types of taxes. So as I say, this is not tax advice, but speak to your tax advisor very, very early on. Ask the right questions, tease the right answers out of them, and you know, really you'll find the benefit in strategic investing. And I'm super passionate about this as a topic. Genuinely, I think that if you can start with the end in mind and be highly strategic with your investing, it not only saves you time and money, but it's also a lot more fun. And you also save money as well in the process. You know, you hold on to your money as much as make it. And ultimately, that's the name of the game. So invest strategically is what I do with my clients. It's how we work. And it's definitely highly, highly recommended. So thanks for listening today. It's great to have you here, and look forward to seeing you next time on the Commercial Property Podcast.